Awesome. It looks like we are live right now, right at 12:30, which is amazing. So first of all, I want to thank all of you who logged in a few minutes early. Appreciate you being respectful of our time. I will try and do the same and be respectful of your time. Our goal today is actually to try and keep this short. We're going to try and keep it to 20 minutes and have 10 minutes of Q&A just to get you right to the facts, right to the meat. And if you do want to dive deeper, we do have longer recording sessions, full hour of this in more in depth, as well as we just did a webinar last week on one of the top 10 tax strategies that we dove into in heavy detail. So we've got these available on our YouTube channel as well as our social media. So it's a great place to check out if you want more meat than what you're going to get today. Now to go through with a little bit of housekeeping to start us off, I do want to encourage Q&A throughout the session. Anyone who's watching live on Facebook, you can post in the comments, and we do have a team member who will relay those over to me here so I can answer them for you. There just might be a bit of a delay. For those of you who are on Zoom with us today, you can communicate with us in 3 different ways. You can use the Q&A, which is the preferred method. We're going to address those first and foremost. You can also use the chat, but I won't be checking that probably till the end. And you can also raise your hand for anyone who wants to actually ask a question, who finds it hard to type out exactly what they're trying to say. You can raise your hand and I'll open up your mic so that you can communicate with us directly. So for those of you who aren't familiar with us, my name is Andrew Wall. I'm the managing partner here at CPA4IT. CPA4IT has been specializing in service-based businesses since 1984. It was founded by my father, George Wall, which means we've got tons of years and experience in your specific industry and knowledge. And we even know real estate or corporations can only incorporate as of last year. A lot of these tax strategies that we've been using for service-based businesses are going to fit right into your mold. And we've got some great things that we're going to cover today that you're probably not aware of that you're going to get now that you have the ability to incorporate and take advantage of all these benefits. We are also a top 50 cloud accountant. What that means is we leverage the latest and greatest technology. Not only do we have decades of experience in building workflows and systems specific to helping small businesses make their accounting processes easier and optimize their taxes, but we also bring in the latest and greatest technology because technology is adapting at an incredible rate. And there's new tools almost on a daily basis that are going to make this process even easier for you. And again, we've got great webinars going back and covering some of the specific tools that we do provide to our clients free of charge to make that process even easier. We are also an ISO 9001 registered firm. That just means we have systems and processes that are externally audited and that have to constantly strive for improvement, which means every year we have someone come in and look at our systems processes, tell us whether we're improving them and making them better. Because we know if we just wanted to be the same accounting firm we were when my father started this practice back in 1984 with his Osborne 64K computer, we wouldn't be delivering the value to you that you deserve. So without further ado, I want to kick off by giving you guys back some value and talk to you about the things that you're going to be able to take advantage of by being able to incorporate. So the areas we're going to cover are the low corporate tax rate, the ability to do income splitting, the ability to do income smoothing, tax deferrals, home and auto loans, insurance strategies, pension plans, capital gains exemptions, and holding companies. There are many more strategies than what we're going to be able to cover today. I just want to give you an introduction to some of the tax strategies that are available to you now that you have the ability to incorporate and help you understand whether incorporation is the right process for you. So first and foremost, I want to talk about the low corporate tax rate. When you incorporate here in Ontario, we have a current tax rate of only 12.2% on your operating income. That is substantially better than the personal tax rate of 53.53% as the highest marginal tax rate for personal taxes. So if you're making more than $220,000, you're going to be paying that 53.53% tax rate on the last dollar that you earn. Whereas if you have the ability to leave that inside of a corporation, you would pay only 12.2% tax on that. And what that means is that you can now have more money to invest or save for retirement. And when you're investing, when you start with a bigger number, that bigger number compounds and grows substantially faster. So being able to leave money or retain it inside your corporation means that you're going to be able to grow your wealth substantially faster than if you were just using a sole proprietorship, where yes, you can deduct expenses and yes, you have some advantages, but you don't get this small business tax rate of only 12.2%. So this is really the core and the starting point of one of the biggest advantages that you're going to get. And I'm not going to talk to you about any of the specifics about the additional expense deductions that you do get in a corporation, and there are a few, but for the most part, what you can deduct inside of a corporation is fairly similar to what you can deduct inside of a sole proprietorship. A few small differences that will give you some additional tax advantages, but nowhere near the benefits that you're going to get by moving income that would be taxed at the highest tax rates down to only 12.2%. And even if you're not at the highest tax rates, you can get some substantial advantages out of being able to incorporate. So the other thing that you're going to get is the ability to do tax deferrals. And this somewhat ties into what we're going to talk about next in income smoothing. When we have a sole proprietorship, basically we get to deduct expenses, but anything that's left over after those expenses, we pay tax on that when we earn the income right away. With a corporation, there's a number of different tax planning strategies that we can use to defer when we pay taxes. We can do bonuses that allow us to declare a salary or an expense that's up to 6 months from the year end of your corporation, which means you're going to get the expense deduction inside the corporation today, but you won't have to pay tax on that personally for another 6 months from the end of your corporate year. And this can be really helpful when we have peaks and valleys, which, like I say, ties into this ability to do income smoothing, which we'll talk about in a second. The other thing that you're going to get with a corporation is the ability to do income splitting. And yes, you can do some income splitting inside of a sole proprietorship by declaring salaries. However, you're going to get more income splitting opportunities available to you inside of a corporation. Now, a few years ago, this was an amazing strategy that allowed you to do dividends to any shareholders, regardless of what level of involvement that they had in the business. Unfortunately, Morneau put in some changes a few years back, late 2017 and early 2018, that put in some new rules that are referred to as TOSI, or tax on split income. And these basically made some rules that made it harder to income split through the use of dividends with primarily children as well as spouses. Now, you can still do income splitting with family members that are actively involved in the business. Again, I'm not going to go into the specifics of TOSI and how to do that and what implications there are and how you're going to do that income splitting. What I can tell you is there are more advantages with a corporation than there are with a sole proprietorship. And when it comes to income splitting and tax planning, this is something that needs to be done with a professional who knows and understands your situation, who knows and understands tax law, and knows and understands the implication of things like tax on split income. Now, income smoothing, as I've alluded to, is one of the huge advantages that comes into play for realtors. It's not uncommon for realtors to have ebbs and flows, great years, not so great years, phenomenal years, good years. And what you get with a corporation is the ability to smooth those years out. So there's not only the ability to smooth income from a corporate perspective by doing things like deferrals and taking salary expenses earlier or later, because when you have a corporation, we can declare a bonus to arm's length employees that can be anytime during the calendar year. And if you've got a calendar year, let's say in July 31st, that's going to already span over 2 calendar years. So let's say it was July 31st, 2021 was your fiscal year end, which means it would start on August 1st, 2020 and July 31st, 2021. That would mean that you could declare salary in the 2020 calendar year, as well as the 2021 calendar year. Plus, because you can bonus out 6 months from your year end, you could actually declare a salary into the 2022 calendar year. So this gives you lots of flexibility in controlling what your corporation will be taxed in. But more importantly, it gives you the ability to control in what year you personally will be taxed in. And this is really, really important because of the marginal tax system. With a marginal tax system on the personal tax salary, when you go into a next bracket, the income inside that next tax bracket is taxed at a new rate. What that means is the more income you earn, the more taxes that you pay. For example, if I had 1 year of $100,000 and 1 year of zero, I would pay more taxes than if I had 2 years of $50,000. Just like being able to split over more family members is also going to give us the ability to lower our taxes. So this ability to smooth income over multiple years, as well as multiple family members, can make a substantial difference, particularly in the real estate business. And I would say arguably, this is the #1 benefit that you're going to get out of a corporation, is this ability to do income smoothing, which is a perfectly legal tax strategy. And it's going to save you, potentially tens of thousands of dollars. I remember looking at one situation where it was in that particular realtor situation, because they'd had such an ebb and flow 1 year over the other. We were talking a $20,000 tax saving just by being able to smooth that over 2 years versus what he was going to have as far as tax implications with a sole proprietorship. Now, that doesn't mean you're going to save $20,000. But what it does mean is you need to speak with a knowledgeable representative who can look at your situation and tell you what kind of tax advantages you're going to have by setting up a corporation. We've also got the ability to do home and auto loans. There's also something called a shareholder loan. And what this is the ability to take a large chunk of money out of your corporation without having to take it into personal tax. And there are a whole bunch of rules around making sure that this is done properly so that CRA does not come back and say, well, no, this isn't a valid loan. And it's actually a shareholder loan rather than an employee loan. And now you have to take it into income. So when structured properly, these can be huge, huge tax advantages, because you can imagine, the real estate market, you guys know better than anyone, how crazy it is in Toronto and how much money you need for a down payment on a home these days. And if you would have to take that money out of your corporation, pay personal taxes on it, and potentially lose 53% of every dollar that you take out of your corporation before you can put the deposit down, that just magnifies the amount of money that you've got to take and you've got to put as your down payment. But if you can take that out of your corporation tax-free and then repay that over an amortization period that you would see typically in the market, like say 20 or 25 years, and take that income into, take that drawings out into income over a 20-year period, it can make a substantial difference. You could be talking $10,000 a year in additional salary versus $200,000 a year in additional salary. And we can do this for the purchase of a home or for the purchase of a vehicle. There are also some unique situations where it has been done for boats, but that gets a little bit more complicated. Again, you got to speak with a knowledgeable representative about what kind of boats would qualify for this. Unfortunately, it cannot be done for a renovation or an upgrade to your home. So that's one of the things to be aware of when it comes to home and auto loans. Now, insurance strategies, these are very, very cool. And there's lots of different insurance types of strategies. I think one thing to know and understand about insurance is there's lots of different types of insurance. You've got life insurance, you've got health insurance, you've got errors and omissions, and there's different tax treatments for them. And they all have different ways that they're dealt with. And some of them we would say, yes, we want to deduct them and put them through the corporation. Usually things like life insurance, we get some benefit out of doing that. Things like disability, even though you can deduct it in the corporation, if you deduct it inside the corporation, the benefit becomes taxable, so we don't recommend it. But life insurance, there's some really big advantages with doing a life insurance policy through the corporation. Even if we're not able to deduct the expenses, it might be an add back depending on the individual situation. But the big advantage is that when the benefit comes out of the corporation, it comes out of the corporation through a special thing called a capital dividend account. And that capital dividend account is tax-free. And there are things that we can do, like an ICE maneuver, which allows you to set up these corporations or set up these insurance plans that allow you to effectively get a huge chunk of retained earnings out of your corporation today, and be able to access those funds again without having to pay personal tax on them. Again, these are advanced tax strategies. We've done whole separate webinars on what these look like. And if you're interested, we can connect you to the right people, which are basically, we're going to have actuaries and insurance specialists and banks all involved in that maneuver. But if you're a high net worth individual and looking for ways to access funds inside your corporation, there's some great strategies to do that. In addition to insurance strategies are pension plans. And in fact, the last time we did this webinar, I basically said, pension plans are these great, amazing tools, but here's a bunch of caveats on all the potential negatives. But I had a pension plan specialist reach out to me and said, hey, there's actually been some updates, Andrew. There was a bill passed here in Ontario that reached Royal Ascension last December that's actually eliminated a lot of these downsides of these risks and the downsides of a personal pension plan, which used to be like things like there was additional costs on managing it, there was some onerous work involved. And here in Ontario, we actually have some good work that's been done by Ford and his government to really take a lot of the bureaucracy out of pension plans, and to create some added advantages for arm's length people. And these are really amazing tools that give you the ability to basically triple the amount of benefit that you would get in an RRSP, and be able to do it through your corporation. That it is a very tax sheltered and protected way, and it's creditor proof, which is great. It's an expense deduction to the corporation, which reduces the taxable income of the corporation, and allows you to defer taxes, much like the way an RRSP does, right? With an RRSP, I think people are familiar with that, where you make a contribution today, it reduces your taxable income, and then you pay tax when you get the money out of your corporation. Well, this does all of those, but it actually multiplies the amount of eligible room that you have, based on things like past contribution, a whole bunch of other things. So you've got more room that you can contribute to. Plus, there's a whole bunch of things that are available for family businesses, where if you have a family member who's involved in your business, that normally with an RRSP, if you were to pass on, all of that income is going to be taxable to the estate when it transfers on to your children. Whereas with pension, there are some added benefits that basically that can just be put back into the pension pool and available for the other family members who are members of the pension as well, without it being taxed. And again, like I said earlier, when we talk about the corporate tax rate, if you are able to invest that money pre-tax, because of the way compound growth and interest works, it will grow substantially faster than if it were taxed, invested, grew, and then you pay the tax when you take it out. So there's some substantial advantages of being able to defer when you pay the tax and be able to invest pre-tax. There's also a capital gains exemption, and realtors, you guys are probably familiar with the capital gains exemption on the sale of a primary residence, which obviously is a great advantage there. But there's also the capital gains exemption on the sale of your shares. And there's a significant capital gains exemption that is available. And right now that is $883,384 is the lifetime capital gains exemption on the sale of shares within a corporation. Now it's not quite as beautiful as I might be making it sound right now. There are things that have to be structured properly. You have to also make sure that you have a buyer that is willing to buy shares rather than assets. So again, potential big benefit, but it needs to be make sure that your corporation is structured properly if the intent is to sell the shares of your asset down the road or the shares of your company down the road. There's lots of things that you have to be aware of. And again, I'm not going to have time to dive into all of those other than to mention there is a potential big benefit here if this is something that you're thinking of doing, is building up a book of business and being able to sell that as an asset. We've also got, lastly, holding companies. And holding companies are a great tool once you've started to build up some wealth inside your corporation. So, we have this great ability to pay only 12.2% tax rate inside the corporation and save it and invest it, which is what we're trying to encourage our clients to do, is to build this net worth where they can live off the annuity of that net worth and have a principal that they will transfer on to the next generation. And that's our goal. And that's why we talk about, our purpose here is to help you organize your finances, create wealth, and transform wealth into a legacy. Really what that's about is building up an asset inside your corporation and also outside. We do look at all of the tools, investing inside your corporation, RRSPs, TFSAs, non-registered investments. We want a holistic plan, but you're going to build up a net worth that is sufficient for you to live off the growth of that net worth so that you're never eating into the principal, and that principal becomes a legacy for you that you are transferring either onto the next generation or to a worthy cause that you think is important. And so building this money up inside the corporation is a great tax strategy. However, again, the Morneau government did us, a disservice by adding in some rules that basically start to erode this low tax rate of only 12.2% when we have a large amount of passive income. And holding companies is one of the ways that we can, it's one of those loopholes or strategies that we can use to work around this $50,000 strategy, as well as to work around the fact that passive income or investment income is taxed differently and in a higher rate than this operating income that's taxed at only 12.2%. So we have, like I said, strategies by leveraging holding companies that typically we'll start to look at once you've got more than about $100,000 of investable assets built up inside your corporation. We're going to start having discussions about whether a holding company is right for your individual situation and when and where we should start implementing that. Now, $100,000 is not cast in stone, but when we set up a holding company, we want to make sure that you're going to get more tax savings than the additional cost you're going to have of setting up and maintaining a separate corporation. Because really, we haven't talked about any of the downsides of setting up a corporation, because there's really only one, and that's the cost of setting up a corporation and the cost of maintaining a corporation. And first and foremost, when it comes to the cost of setting up a corporation, we've been doing this, like I said, since 1984, and we've been offering paralegal services to help you get incorporated. And we have one of, if not the cheapest paralegal services that you will find on the internet. Now, I know there's a lot of people out there that advertise it's free. It's not free. They're saying there's no charge over and above the government cost. Our services will basically be on par with the government cost, plus you're going to get the added advantage of having someone who's been doing this since 1984 help you structure that corporation correctly. So we're going to provide great help in getting those corporations set up and structured cost effectively. But you're still going to have ongoing accounting fees, whether that's with us or another accounting firm, to help you file your corporate tax returns. Because although you are able to file a corporate tax return yourself, much like you can file a personal tax return yourself, a corporate tax return becomes substantially more complicated than a personal tax return, even if you were a sole proprietor. Basically, a sole proprietor adds one more schedule to a personal tax return, whereas in incorporation, we have a lot more schedules and a lot more due diligence that is required to do that. But what I can tell you is when structured properly, a corporation is going to save you substantially more money than what it costs you in maintenance. And we've got some calculators again on our website. If you want to look at what the potential tax savings would be of incorporating, of what you would pay in taxes as a sole proprietor versus a corporation. That will give you a good high level. Now, obviously, it's very high level. That has got a whole bunch of caveats on that form, but it will at least give you a perspective of the type of savings that you could achieve by incorporating. And again, we do offer a free initial consultation if you want to come in, talk to one of our experienced representatives about your specific situation and see what kind of specific benefits that you could receive by incorporating and whether incorporation is actually right for you. Because there are some situations where incorporation is not the right fit. If you are, doing this as a sideline hustle and only making a small amount of money, there may not be a benefit out of setting up your a corporation. And we'll walk you through and give you real world, honest feedback. We're not going to encourage anyone to incorporate that we don't believe is going to get a real financial benefit out of it. But as you can probably tell from what we've gone through in just these top 10 tax strategies, there are a lot of potential tax benefits and a lot of advanced tax strategies that instantly open up the minute you incorporate and take advantage of these new rules that came into effect thanks to the hard work that your governing body did. And it took them years to be able to get this benefit for you. And I know a lot of you still aren't really sure whether it's right for you yet. And that's why I'd say come in, speak to a knowledgeable representative. You've taken the first step by coming to these sessions, trying to educate yourself and learn more about the benefits that are out there. But come in, take the next step and book a free consultation and we'll see how we can help. And with that, I think I am pretty much wrapped. I think I was pretty good. How am I doing on time? I went a little bit longer. I'll open it up to Q&A. If anyone has any questions about any of these specific tax strategies or wants to know what next steps would be right for them, please post it into the Q&A and I'll be happy to address them. I'll give it about 3 more minutes before I do close out the Q&A. And so far I don't see any coming through, which means one of 2 things. I have given you all the information that you need, or I've bored the pants off you. Oh, here we go. We got someone brave enough to ask a question. Will you be sharing the recording with attendees? Yes. So this is streaming live on Facebook right now. The minute we end the presentation, it will be, well, a minute or 2 later, it will be available on Facebook. Although, mind you, Facebook has been, removing some content lately. Our last PPP session was actually taken down by them. If you don't find it on Facebook, it will be on our YouTube channel within a week. So these sessions are available there, and as well as past sessions. So we've done a couple of these. We're going to continue to put these sessions on as long as you guys are interested and as long as people are registering. Yes, it will be available. We've got a couple more people who are brave. So can I transfer money from my sole prop to my PREC? Not really, because I guess it depends. So there's a misunderstanding. A sole prop does not actually have retained earnings. It doesn't hold money. That's money that you have personally. Can you put money that you have personally into a corporation? Yes. Would there be a tax benefit to doing so? No, because you've already got that money outside your corporation. Right? It's already been taxed. So putting it into a corporation isn't really going to provide you a big benefit because, well, you can invest inside of a corporation. I did mention earlier that the tax rates on passive income are different than the tax rates on consulting or active business income. So that tax rate is very similar personally as it is inside of a corporation. And particularly if you're earning like dividend income, you basically pay this dividend tax, goes into something called an RDTOH, recoverable dividend tax on hand, and you get that tax back if and when you issue a dividend to yourself. So, on dividend income, there would be absolutely no benefit moving that and investing it inside the corporation. So yeah, you could, but I wouldn't really see why you would. Okay. Is tax smoothing handled by an accountant on an annual basis? Great question. Yeah, typically it is. So with our clients, typically we'll do tax planning on an annual basis. Typically with your year end, once we have access to all the financial information and we can look and understand at what has happened, as well as discuss with you about what is going to happen for the upcoming years, we'll create a tax strategy that's based on the information that we have on hand. Now, you can change that tax strategy anytime that you'd like throughout the year. And in fact, one of the other things that we also do, you'll notice we put a lot of webinars on. And one of the webinars we do is around source deduction planning and tax planning in the November and December period. So it's quite common for us to circle back around the end of the calendar year, because obviously the calendar year for personal taxes ends December 31st. So if we want to make any changes to the tax planning and tax strategy, it has to happen before, actually, it's either January 3rd, 10th, or 15th, because that's when you have to pay the taxes on any additional salary that we're going to declare to you. Accountants typically have a trick up their sleeve. And there's always not always, there's usually a backdoor strategy that we can do. So even though we definitely aim for that December 31st year end, we've always got some maneuvers up our sleeves, especially if you're willing to pay, back penalties, which we do everything we can to make sure that we're not doing that. But unfortunately, when some people leave this to the very last minute and don't do tax planning with their accountants up front, sometimes it's worth paying the penalty to do a late filing, to do an amendment, to optimize the tax strategy. So I know some of you are like, hey, I've just done my year end not too long ago for my personal taxes. I don't need to worry about this stuff yet. I would disagree with you. You want to get enrolled with an accountant as early as you possibly can to start getting those finances organized quickly and easily now, as well as to figure out a tax planning strategy to make sure that we're optimizing it. Because as accountants, we have a lot more doors open to us when we can plan for the future rather than react to the past. When we react to the past, we're a lot more limited in the strategies and maneuvers that are open to us, as well as potentially subject to interest and penalties and all sorts of other things that are negative. So great. I think that's all that's come through for the questions. I want to thank you guys for taking time out of your very busy schedules to come check out this webinar. We'd love to hear your feedback. If there's things you'd like to see different, if there's more content you'd like to see. These seminars are here for you to provide knowledge and value to help you make the educated decisions that you need to make when we're in a period right now where there's a lot of new information, a lot of changes, and I know it can be overwhelming. Just let us know feedback of what we can do to make this more approachable and easier for you to digest, to absorb, and to implement. And with that, I'm going to thank everyone for their time and close out this session. Have a great day, everybody.